Hi, it's Helen Tarrant. Hi, and welcome to another episode of Commercial Property Roadshow. Today I'm actually going to assess how to buy a vacant commercial property. So I've talked a lot about tenanted commercial properties, and when you buy tenanted commercial properties, you actually are looking at the yield and the return, so the cash flow position and what you're getting in the cash flow. But when you buy a vacant property, most of the time it's for owner occupiers. So what do you look for when you're buying a vacant property? So that essentially worked on rate per square meter. So I want to show you a quick snapshot of a property, and I want to share with you how I would assess as the rate per square meter. So normally we would look at the comparisons. So how much is next door, someone down the road, the same use of property. So if you're looking at buying a vacant warehouse for self-use, or if you're buying an office space, you're literally looking at something next door to you or the next building and looking at what the rate per square meter is. I also like to look a little bit further back into history and seeing, okay, so what did this property sell for? What was the rate per square meter a few years back? I just want to know if I'm going to occupy this property myself, whether I'm going to get any kind of capital gains in the future. So that all helps to understand and establish a purchase price for that property. So let me just take you in and show you a case study so that you understand what you're looking for. So I'm going to share with you this property that is vacant. This property is in West End in Brisbane. So I want to share with you. So this is a facade of what it could look like. This property is a classic vacant property on a corner block. And there's many of them all around Australia in different pockets of Australia. But this just happens to be in West End, a growing gentrifying suburb of Brisbane. The yield's pretty sharp in that area. So you're buying something around 5-6% at the moment. And you can see that it's a bit of an old building. The facade is pretty old. There's not that much going for it. You've got the layout internally. So it's been sort of done quite open plan. You can see that it's Brisbane CBD, and that we can see that here we've got the wooden floors, we've got one set of stairs, and there probably need to be a second set of stairs. So it talks about what the property is. It's got vinyl floors upstairs, it's got bathrooms, warehouse space, as well as office space. So you can see it's quite neat and tidy, and we can see the layout is absolutely open plan. And of course, outgoings is a section we need to pay attention to. If you're looking at a property you're going to self-occupy, because you need to know how much that is going to cost you per year as well. So this is the property as is. At the moment, there's bathrooms, but this is what it could be on this side. So on the right-hand side, we can see what it could be, and then we're going to see what the DA is in this property. So you can see the facade is a bit old. There's limited parking space around there, and that's going to be an issue in terms of being in somewhere that is so gentrified like West End. Of course, there's some information about the property itself, and there is information regarding all of the DA plans. So I'm just want to show you that there's some DA plans here. So original, this is what the property could be. And different tenancies are turned into 5 retail type tenancies. But of course, if you're turning into 5 retail tenancies, you might consider parking along either side of that property. And of course, we've got a warehouse space as well. So bottom and upstairs as well. So we can see that that's the DA already approved on this property. So with a property that's already got DA approved, you're probably paying a little bit more for it than if you were had a property without it. But you also got to think, is that applicable to you as an owner occupier? So if you're owner occupier and you're either in events or you're warehousing or you're in logistics, this might not work for you. So it's all about functionality, but this is ultimately what this property could be. So this has a bit more information about the property itself, about the DA, mixed use. And the most important thing, obviously, here we're paying attention to is the zoning. So it's a mixed use corridor zone, so which means you can do multiple uses for it. You could, with material change of use, you could make it a retail shop front or outlet, plus you could possibly look at professional office space above as well with permit, as well as maybe warehouse. Of course, this is in an industrial area at the moment. So there's some building plans here, existing building, and what it could be in the future. So this is where it is. It's got the bathrooms on one side, upstairs, and totally open plan downstairs. And currently. So all of this information, if you're looking at a property that's vacant with development potential and the vendor has already gone out and actually done a DA. If it hasn't, you will just see the property as is. So this is if you're buying vacant and plan to do something with that property. Obviously there's some outgoing, so you get to see the council rates and insurance on this property as well. So and then there's obviously general disclaimer for this property. So one thing I look at is what this property would be in terms of what it was sold for a little while ago. So it was bought in 2016 for just under $2 million. The site valuation is really important. The land value is actually quite high, which signifies that the area is actually growing. The land value is increasing, so that's a good sign. So it's reasonably valued at 1.5, which is why you have to pay land tax on it. This is just a little bit of the history of the property as well. And there's some it gives you a bit of the history, and that's what RP data is good too. It doesn't always show you everything in terms of a commercial property space, but it sure as hell shows you some basics that you need as well. So from here, I want us to have a look at the different types of the properties in terms of per square leasing. So let me have a look at that. Let me just bring that up as well. So I'm just going to stop share and share something else. So I've asked for evidence, sales evidence, and the reason we ask for sales evidence is so that we can see what the rental is around there, and also what is the rate per square as vacant. So here we see 259, 379, 70. On Montague Road, that is most important. You can see that it's been sold in between 4,400 a square meter to just above 5,000. And I would check out the land space. I mean, this is 728 square meters, which is about the same size as the one we're looking at. But I'll also go and do a more thorough look of what they are, and as a comparison. Here, the rental per square meter is interesting because we've got different types of tenants and obviously paying different types of rates. So we've got Scrunch and F45. They're going to be in last industrial space. They're also a slightly branded tenant, so 336, 200. I'll check out where the areas are. Professional College, obviously a little bit different, but they also have a slightly larger space, so it's a little bit cheaper. Dance Studios and D1 Group, so different types of tenant paying differently. But this will be interesting for me to have a look at. They are paying gross, so there's some outgoings, but they're still paying way above market. So I eliminate that, and I'm just looking at the average of those. So the property as is, probably at this moment, I will put it somewhere around that 250 to 260 per square meter range. And if I work it out that way, it's got 720 square meters. So 728 square meter times 200 and say $50 a square meter is 182,000. The rough return around West End is about 6%. We'll put this property at about 3 million. Now that's probably a little bit light. If I was looking at 4,400 a square meter based on the vacant one down the road times by 728, it's 3.2 million. So the gap's probably somewhere around that 3 to 3.2. So if I'm looking at this, I'm going to be thinking if I get this property anything less than 3 mil, it will actually be a good buy because I'll still have to refurbish it. I'll still have to cut it up. There's still quite a bit of work. And with the DA, I could get a quote and it could be somewhere around, anywhere from 200,000 to 400,000 to do what that plans is. So I need to take that into account. So if I was starting an offer with that property, I'll probably start in the mid twos and try to come to a negotiation so that I allow for time for it to be all totally fully fitted out. Because ultimately, when it's fully fitted out and ready to go, I want actually for it to achieve more that high end space. That 336 to 300 and maybe $50 a square meter because it's a brand new space, and therefore I'm increasing the value of that property. Because if I can get that property to that rate at $728 728 square meters by something like 350, it's all of a sudden 254,000, and that by 6% yield makes the property a $4.25 million property. So in the process of doing that, I've earned myself over $1 million after expenses on this property uplift. And if I'm looking at
vacant property and looking at cutting it up and doing it, that's what I'll be looking at aiming to do. So if I was to put an offer, and that's how I would assess it, and that's how I would put the offer in. But of course, it's subject to due diligence because you need to check all of the zoning, talk to town planners, get quotes for the building. I want to look at the roof as well because there's some rust on the roof. And of course, it's subject to finance because the bank will have to value the property as is, as a vacant property. So there's still a bit of work to be done. But definitely, if I was looking at a vacant property, either for owner occupier, I need to look at it and see what I'm going to use it for right now, or if I'm going to cut it up and do it as an uplift, then I'm going to be checking the sales evidence, the leasing evidence, previous RP data, as well as the location of this property, and looking at parking and what kind of tenants I can put in there and how much it's going to cost me to go through and make it a tenable property. So on that note, I will follow this video up with some smaller spaces in terms of vacant, so you get to know how you would do it if you're buying an office space on its own and what you can do in that space. But until next time, I look forward to seeing you on my next episode.
So I hope that's been really helpful for you to understand what to look for when you're looking at a commercial property, and for you to understand the rate per square meter that you should be looking at, how to assess it, and especially for your own needs as well. Because remember, if you're owner occupier, it's okay to pay a little bit more for the property, but ultimately you're always going to be looking at the things: is there going to be enough parking for the future? What can you do with that layout and that zoning? And ultimately, what do you want to do with the property when you no longer use it? So if you're looking at your own commercial property, or you're looking at vacant property as a strategy and maybe cutting it up and putting tenants in there, and you want some help, go to helentarrant.com, send me a message. In the meantime, hit the bell, subscribe, and I'll see you in the next episode. Bye for now.